Are we in AI bubble? Who will benefit, and what are the risks? Are chip makers the modern-day shovel manufacturers for gold rush explorers? What chip makers are still undervalued? Keep on watching as we explore potential losers and winners in this AI revolution. By now, everyone have heard about ChatGPT and its large language model with trillions of inputs for training, which can summarize in a very coherent way vast amounts of data, closely resembling human intelligence. In addition, there are many other generative AIs out there for voice, music, artwork, and video. Everyone wants to get on this AI bandwagon and ride the wave. However, just like in .com era, there will be winners and losers. At this point, it is very hard to know which software companies will win and which company will build the best AI tools and models. As such, any investments based on hype present considerable risk. With the advancement of ChatGPT, many smaller companies who have previously heavily invested into similar general-purpose AI models will most likely fail, unless they will figure out how to adapt, innovate, and maybe even rely on some of the best third-party AI.
So, are AI stock valuations a giant bubble?
Take a look at a company for enterprise AI C3 AI. Their stock grew from about $11 in January of 2023 to a high of about $44 in May of 2023. This is a 4x growth in just 6 months. Who would not want to make such crazy returns on this investments? However, after reporting their recent earnings, the stock took a 25% tumble. As of early June 2, 2023, the stock is at $32.26. This is still a 191% growth year to date.
Wow, this is incredible, but sure does look like this stock has very high volatility. So which companies may benefit from AI revolution?
It is very hard to tell now who will benefit. Even big software companies with their billion-dollar budgets to finance AI research and development could still have considerable risks. Microsoft Bing had already integrated ChatGPT into its search and is available for free with limited capabilities to anyone. While Google, with over 70% of their revenue coming from search business, still have a wait list for its AI-powered search. Both Bing and Google struggle to rapidly increase their computational capacity to support the demand. This is also true for many other AI startups. They all need massive compute resources, not just CPUs, but fast GPUs, which are usually 5 to 10 times more expensive than CPUs.
If so many new companies need GPUs, would GPU chipmakers be clear winners in the next gold rush? Aren't they providing sticks and shovels for gold miners?
Well, let's take a closer look at some of them. NVIDIA stock grew a whopping 174% since the start of 2023, and the company even briefly reached $1 trillion market capitalization after announcing its latest earnings and sharing their growth projections. NVIDIA could very well be one of the winners in this revolution, but there are many other players as well. While NVIDIA GPUs are being offered by many cloud providers, including Paperspace and AWS, other chipmakers try to not miss this boat. Intel, Amazon. Yes, can you believe it? Amazon also makes processors such as Graviton and Trainium. There are also AMD, Apple, Qualcomm, and others. However, many of the above players rely on Taiwan Semiconductor Manufacturing to actually manufacture its GPUs.
Very interesting. So, what is the best AI shovel and what are the risks?
Let's take a look at some of their financials. In fact, I used ChatGPT to help me summarize financial data for Intel, NVIDIA, and TSM. Please note that these figures are subject to change and should be verified from the respective company's official financial documents or reliable financial news sources. Also, keep in mind that financial metrics can be calculated in different ways, so the figures may vary slightly depending on the source. Before we dive into these companies' financial, let's first understand what PEG ratio is. The PEG ratio, or price-to-earnings-to-growth ratio, is a financial metric used to evaluate the valuation of a company's stock by taking into account both its price-to-earnings, or PE ratio, and its expected earnings growth rate. It provides a more comprehensive analysis of a stock's value relative to its earnings growth potential. To calculate the PEG ratio, you divide the PE ratio by the projected earnings growth rate. The PE ratio is determined by dividing the stock's current price per share by its earnings per share, or EPS. The earnings growth rate is typically the projected annual growth rate in EPS for the company. The PEG ratio helps investors assess whether a stock is overvalued or undervalued based on its earnings growth potential. A PEG ratio below 1 is generally considered favorable, suggesting that the stock may be undervalued relative to its growth prospects. A PEG ratio above 1 may indicate an overvalued stock or lower growth expectations. It's important to note that the PEG ratio has its limitations. It assumes that the projected earnings growth rate is accurate, which may not always be the case. Additionally, it does not take into account other factors that may affect a stock's valuation, such as industry trends, competitive landscape, or macroeconomic conditions. Therefore, it should be used alongside other fundamental and qualitative analysis tools when making investment decisions. Let's take a look at Intel. Intel's PEG ratio, according to FinanceCharts.com, is 0.41. This should indicate it is undervalued. However, let's look at some other data. Intel's gross margin was 38% in Q1 2023, down about 16% year over year, from 54% in Q1 2022. Their operating margin was negative 6% in Q1 2023, down 32% year over year, from roughly 26% in Q1 2022. The net margin was negative 5% in Q1 2023, down about 37%, from approximately 32% in Q1 2022. The free cash flow in Q1 2023 was negative $2.9 billion, down from a positive $1.3 billion in Q1 2022. INTC stock grew only modestly, by about 17% year to date.
Interesting. With all of the AI boom, why don't Intel's financials look good? And why their stock hasn't moved as much as others, while the PEG ratio indicates the company is undervalued?
Intel has many expenses related to building new chip manufacturing capacities in the United States, specifically in Ohio and Arizona. Building those factories is very costly. They have invested over $50 billion into this expansion. We will touch a bit later in the video on why Intel and others are investing in manufacturing in US versus elsewhere, such as Taiwan. Now let's take a look at NVIDIA. NVIDIA has a much stronger balance sheet, and like Intel, is also investing into manufacturing within the United States. NVIDIA's gross margin was a negative 6% in Q1 of 2023, down 32% year over year from about 26% for the same quarter prior year. Their operating margin was about 56% in Q1 of 2023, down about 9% year over year from 65.26% a year earlier. The net margin was 18.5% in Q1 2023, down 13.5% year over year from about 32% in Q1 2022. The free cash flow was $1.69 billion, down from about $1.9 billion for the same quarter a year earlier.
What about TSM? Seems like this is the shovel of all shovels, since many chip designers are using their manufacturing capacity. Could this be a better bet?
Seems like TSM has a very strong balance sheet, and they are also expanding manufacturing capacity in the United States. Their PEG ratio also indicates the company is undervalued. Taiwan Semiconductor's stock grew over 33% since the start of 2023. Their gross margin is 59%, which is up 3.5% from last year. The operating and net margins are 49% and 44% respectively. Free cash flow in Q1 2023 was $1.39 billion. While less than a year ago, it is still good considering their expenses for expanding manufacturing capacity.
So why the stock hasn't grown much?
The answer is most likely due to geopolitical tensions between China and Taiwan. For those who just came from the moon and not sure what I am talking about, look what happens when you just do a quick search. To sum this all up, there is no clear answer as to where to invest, but as we discussed, some companies may have more advantages, better marketing, and lower risks. Chip makers provide tools for AI revolution rather than building specific AI software, and some of them manufacture those chips for big brands such as Apple, Amazon, NVIDIA, and others. Who will eventually succeed, only time will tell, but I am hoping this information was helpful and entertaining. And remember, before investing, consult with your personal financial advisor.